Breaking news tonight. A private demand by President Donald Trump for critical heavy machinery has ignited a fast-moving political and economic standoff that is now spilling across trade, manufacturing, and diplomatic channels. According to multiple reports, this was not a routine request, and the response was not a negotiation, delay, or compromise. It was a single word. And that one-word reply is now triggering what analysts are calling a cascading crisis, with consequences far beyond machinery. This story matters because it exposes something much larger than industrial equipment. It reveals how fragile supply chains have become, how leverage has quietly shifted, and how economic diplomacy is now operating under far more strain than many policymakers are willing to admit. What began as a demand for machines has become a pressure point that could affect American workers, infrastructure projects, markets, and even the future of North American trade. Here's what happened. During late-stage discussions tied to infrastructure development, logistics bottlenecks, and industrial supply chains, Donald Trump reportedly pushed for accelerated access to heavy machinery assets, equipment essential to large-scale construction, extraction, and transportation projects. These are not generic tools. They are ultra-specialized machines, often costing millions of dollars each, produced primarily in Canada, Germany, and East Asia, and already committed under long-term contracts to other buyers. According to reporting citing Reuters, Bloomberg, and the Financial Times, the request centered on fast-tracking delivery schedules and effectively overriding existing export priorities. The timeline was aggressive, measured in months, not years. For manufacturers and policymakers on the receiving end, the demand raised immediate red flags. The response, according to multiple sources, was not dressed up in diplomatic language. It was not softened by conditions. It was one word: no. That refusal reportedly came from a key international partner whose manufacturing sector supplies roughly 22% of total U.S. heavy industrial machinery imports based on 2024 trade data. Analysts immediately flagged the moment as a potential inflection point, not because of the word itself, but because of what it signaled. This was not about availability alone. It was about who controls supply chains, who holds leverage, and who absorbs the pain when pressure is applied. The timing could not be worse for the United States. This demand and refusal come amid a severe materials crunch already gripping American industry. U.S. aluminum prices have surged more than 40% since June 2025, reaching record highs above $5,200 per metric ton. Inventories have collapsed from roughly 750,000 tons at the start of 2025 to under 300,000 tons today, a devastating 60% decline in just 12 months. Construction firms across the country are reporting mounting delays and cost overruns. The Midwest aluminum premium has hit a record 96 cents per pound, up roughly 65% in less than a year. Canadian suppliers, which account for nearly 70% of the roughly 4 million tons of aluminum the U.S. imports annually, have sharply reduced discretionary shipments. Under Trump's 50% tariff structure, many are losing money on U.S. sales. To understand the human impact, consider a construction foreman in Ohio managing a federally funded infrastructure project. Machinery deliveries are delayed. Aluminum costs are exploding. Every month of delay risks penalties, layoffs, and potential contract termination. Multiply that scenario across thousands of projects nationwide, and the scale of the risk becomes clear. What looks like a single-word refusal is now rippling outward from factory floors to boardrooms to diplomatic back channels. So why did this escalate so quickly? To answer that, you need to understand how heavy machinery supply chains actually work. These machines are not interchangeable widgets. A single high-capacity excavator, crane, or turbine transporter can cost $5 million or more. Lead times often run 12 to 24 months. Each unit depends on hundreds of upstream components sourced globally. According to OECD data, more than 68% of specialized industrial machinery used in U.S. megaprojects is imported. That dependency creates vulnerability. Trump's reported demand sought to reprioritize U.S. access, effectively leapfrogging other buyers. Analysts describe it as a test of leverage, an attempt to see whether political pressure could override contractual obligations and industrial reality. But the supplier country, particularly Canada under Prime Minister Mark Carney, faced its own constraints. Labor shortages, energy costs up more than 30% since 2022, and binding commitments tied to climate transition infrastructure. More importantly, Carney recognized that Canada's leverage was unusually strong at this precise moment. That leverage was created in part by Trump's own policies. When the administration doubled aluminum tariffs to 50% in mid-2025, the stated goal was to revive domestic production and reduce import dependence. But tariffs do not instantly create capacity. You cannot build aluminum smelters or machinery plants overnight. While American industries still need aluminum and equipment immediately, for cars, aircraft, buildings, and energy infrastructure, Canadian exporters ran the numbers and concluded they could not profitably supply the U.S. market under the new tariff regime. So they redirected shipments to Europe and other regions. The result was a rapid drawdown of U.S. inventories and soaring prices. Industry experts have been blunt. Gregory Whitbecker of Whitson Commodity Advisors noted that Canadian suppliers stopped discretionary shipments because they were losing money, directly causing the inventory collapse. Jorge Vasquez of Harbor Aluminum warned that current premiums are far above what costs justify, reflecting not just physical shortages, but fear of worse conditions ahead. This fear-driven pricing compounds the damage. History offers a sobering parallel. In 1973, oil embargoes demonstrated how quickly supply leverage can shift geopolitical power. In 2021, semiconductor shortages wiped out more than $210 billion in global auto production. The current situation follows the same logic. You can demand priority access, but if capacity is constrained, someone else gets pushed out, or everything grinds to a halt. The refusal to Trump's demand was not personal. It was structural, but it was also strategic. Mark Carney, a former central banker who has governed through crises before, understood that saying yes would relieve pressure on American industries at the very moment Canada held maximum leverage, just months ahead of the critical USMCA review scheduled for July 2026. From a game theory perspective, the calculation is clear. If Canada immediately supplies what Trump needs, U.S. pressure eases and incentives to negotiate diminish. If Canada holds firm, pain intensifies for American manufacturers, construction firms, and consumers. That pain creates political pressure inside the U.S. to reach a real deal, not issue demands. Markets noticed. Shares of several U.S. infrastructure and construction firms dipped within days. Logistics insurers adjusted risk premiums. Analysts began modeling retaliation scenarios. The construction sector, already strained, is now facing chaos instead of predictability. The consequences spread fast. Manufacturing plants in Michigan and Pennsylvania face scheduling uncertainty. One delayed machinery shipment can idle hundreds of workers. In Texas, energy infrastructure projects are warning of cost overruns exceeding 80% if delays persist. Fixed-price contracts are becoming financial traps. Small construction firms, operating on razor-thin margins, are especially vulnerable. The automotive industry is exposed as well. Aluminum is essential for modern vehicles, particularly electric models that rely on lightweight materials. Higher input costs mean higher vehicle prices, production slowdowns, or plant shutdowns. Aerospace manufacturers report disruptions to specialized alloy supplies. Even food and beverage packaging is affected, pushing costs down to grocery store shelves. Internationally, the implications are profound. European officials emphasize the sanctity of contracts. Asian suppliers are wary of political interference setting dangerous precedents. Canada is accelerating diversification, engaging more deeply with Europe and Asia. Prime Minister Carney's recent outreach to Beijing underscores a broader shift. Canada is actively reducing reliance on a partner it now views as unpredictable. For Europe and Mexico, this crisis is a warning. If tariffs can destabilize trade with America's closest ally this severely, no partner is immune. Analysts at major think tanks warn that politicizing industrial supply chains accelerates fragmentation, making everything more expensive and less reliable. Legally, Options are limited. Dispute mechanisms exist under USMCA, but they move slowly. Invoking national security provisions to compel cooperation would almost certainly trigger retaliation and risk collapse of the agreement itself. Politically, the pressure inside the U.S. is growing. Pro-business conservatives are hearing from corporate leaders about real damage. Democrats are calling for hearings, framing the crisis as evidence of failed economic strategy. In Canada, the political effect has been the opposite. Carney's approval ratings have risen. Even opposition voices are backing a firm stance, viewing it as a necessary defense against economic coercion. That domestic support gives Ottawa more room to hold the line. The next 30 to 90 days are critical. Watch for delayed projects, revised budgets, reduced manufacturing shifts, and intensified back-channel negotiations. Over 6 to 12 months, the risk becomes structural. If partners diversify permanently, U.S. leverage erodes long-term. Here's the bottom line. A demand for heavy machinery exposed supply chains stretched to their limits. A one-word refusal triggered economic, political, and diplomatic ripples already hitting American workers and businesses. And the fallout now threatens the broader framework of North American trade as the USMCA review approaches. Power does not come from demands. It comes from leverage you can enforce. Trump's tariffs were meant to create leverage. Instead, they created dependence. And when that vulnerability was recognized, it was answered with one word that may reshape continental economics for years to come: